Welcome to the presentation on Fuzzified stock market forecasting with transformer networks and adaptive portfolio management using reinforcement learning, presented by Chia. This project is motivated by the complexity of financial markets and the explosive growth of data. Traditional approaches struggle with the intricate dynamics of the financial markets, and most deep learning techniques, such as black boxes and lack transparency. This sets the stage for the application of fuzzy logic in price forecasting for interpretability. This project presents a novel approach to stock market prediction and portfolio management by integrating deep learning, clustering, and reinforcement learning techniques. We use a custom interpretable transformer network, which leverages self-attention mechanisms to predict stock prices while providing insights into the importance of historical data points, achieving 0.99 R-square over 13 days of forecasting. We use Hebbian learning and fuzzy logic to associate fuzzy inputs with outputs, creating interpretable rules to bring transparency behind the decisions of the transformer model. For portfolio management, we implement the advantage actor to critic, a reinforcement learning model to dynamically optimize asset allocation based on predicted stock prices. We demonstrate enhanced performance in both long-only and long-short strategies by evaluating key financial metrics such as the Sharpe ratio, annualized returns, and maximum drawdown. For our experiment, we have chosen to focus on the top 100 stocks from the S&P 500 constituents as of September 6, 2024. The S&P 500 index is a market capitalization weighted index of the 500 leading publicly traded companies in the United States. The S&P 500 represents a broad cross-section of the US economy, covering various sectors and industries. And by selecting the top 100 stocks, we ensure a diverse range of companies in our dataset, while maintaining a manageable dataset from a computational perspective. As we are selecting stocks with large market capitalizations due to S&P 500 being a market cap weighted index, these stocks are typically in the most liquid in the index. This liquidity is crucial for ensuring that our simulated trades have limited market impact, which helps us limit real-life market frictions, such as shorting costs and other transaction-related expenses. This is crucial for applying our research trading to real-world environments. In choosing large stocks of large companies, also ensure that we have more reliable data and longer historical prices that can encompass significant market events and various market conditions over the past few decades. We utilize the Y-Finance Python package to retrieve the data from Yahoo Finance, which is a free and reliable source for financial data. Our analysis covers a comprehensive 26-year period, starting from January 1st, 1998 and ending on January 1st, 2024. For each day and each stock, we retrieve the open, high, low, and close prices, plus the trading volume. It is crucial that we adjust our price data for corporate action, such as stock splits and dividends, and this adjustment ensures that our return calculations are accurate and reflective of true investor returns. During the initial data exploration, we discover anomalies in price data, and to maintain the integrity of our datasets, we exclude tickers that suffer from these anomalies. Finally, we engineer a diverse set of features to capture different aspects of stock behavior, such as momentum, volatility, volume, and trends. And these steps result in a total of 79 daily features per stock. After pre-processing, we enter the fuzzification step. Fuzzy logic is a computing method that considers degrees of truth rather than traditional Boolean logic. For example, instead of saying that the water is 56 degrees, we can say that it is a little cold, quite warm, and very hot. Fuzzification is the step where we transform crisp input values into fuzzy sets. This diverse set of clustering methods allows us to capture various data structures and patterns that may be present in financial time series. We fuzzify the 79 stock features and outputs with these 9 distinct clustering algorithms. And later on, we investigate how different methods of creating fuzzy sets impact the accuracy and reliability of stock price predictions. This is an example of the fuzzy sets as a result of HDB scan clustering on the 3-month returns volatility feature, producing 4 distinct fuzzy sets. Our stock price forecasting model employs a custom transformer architecture, adapting the powerful sequence-to-sequence modeling capabilities of transformers to the task of time series prediction. The core of the model combines a transformer encoder with a multi-layer perceptron for output processing. The transformer model is run in parallel with a fuzzy rule-based layer, which allows them to share the same vocabulary, enabling interpretation of the transformer layer. To optimize the performance of the transformer layer, we implement a genetic algorithm for hyperparameter tuning. Genetic algorithm is a method for solving optimization problems, taking inspiration from the natural process of biological evolution and natural selection. Treating hyperparameters like genes, we can use crossover to select the better settings and mutation to explore our search space. This approach optimizes hyperparameters such as the number of attention hits and the number of MLP layers that we should use for each of the 9 clustering algorithms that we use in the fuzzification step. And this allows us to efficiently explore the vast hyperparameter space and identify the most effective configuration for our stock price prediction task. The optimization process is conducted using a train validation split of the data. We split the training set further with a 70-30 split to produce a train validation set. This training set is set to the dates of January 1st, 1998 to the end of 2015. This approach ensures that the hyperparameters are optimized on a subset of the training data, leaving the test set completely untouched for final model evaluation. Here we present the prediction performance of our transformer model for forecasting close prices from T+1 to T+13 days. The R-squared scores reported are averaged across the top 10 stocks in our universe for the test period spanning from 2016 to 2024. The results demonstrate that our transformer model, combined with various clustering techniques for fuzzification, achieves remarkably high R-squared scores across all 13 prediction horizon days. HDB scan emerges as the top-performing clustering method with the highest mean R-squared score of 0.9939. It consistently maintains high accuracy across all prediction horizons, suggesting that its density-based approach captures meaningful patterns in the stock price data, which are efficiently used by the transformer model to predict the next day's close price. Here, we present the prediction results for the T+1 close price of Amazon throughout the evaluation period of 2016 to 2024. We can see that the predicted prices in green are very closely follow the true close prices in red due to the high prediction accuracy. Comparing our predictions across the prediction horizons of T+1 all the way to T+13, we notice a general trend of performance degradation as the prediction horizon extends. This is expected due to the increasing uncertainty in longer-term predictions. This is also visually evident when we compare the plots for the model's predicted performance against the plot on the right, which represents the T+9 price prediction for Meta, where the green line evidently deviates a lot more from the actual close price in red. Our portfolio management strategy utilizes the combination of 4 key technical indicators as trading signals: the MACD, RSI, a rune oscillator, and stochastic oscillator, which are said to capture the momentum and trends of a stock, are used. These trends are calculated using historical data and our model's predictions, allowing us to generate forward-looking trading signals. This approach aims to combine traditional technical analysis with our advanced forecasting model and results in 3 variations for each trading indicator that which we will investigate. For portfolio management, we employ the advantage actor-to-critic reinforcement learning algorithm. The A to C algorithm is a policy gradient method that combines the benefits of both value-based and policy-based reinforcement learning approaches. It consists of 2 main components: the actor, which is the policy networks that decides which actions to take, and the critic, which is the value network that estimates the value of being in any particular state. By using A to C, our model can learn to make dynamic portfolio allocation decisions based on the forecasted trading signals and current market conditions, potentially outperforming traditional static strategies. We adapt the stock market environment from the FinRL Python package for our long-only Python simulation. The environment's reward function is based on daily returns, encouraging the model to maximize portfolio performance. And our portfolio management environment allows capital allocation across 100 stocks in our universe, plus a cash position, resulting in 101 possible allocation targets. The strategy using ideal signals demonstrates the best Sharpe ratio of 0.95. This is closely followed by the predicted signal strategy with a Sharpe ratio of 0.93. Both of these outperform the buy and hold and mean variance optimization strategy benchmarks, indicating superior risk-adjusted returns. However, our predicted signal strategy outperforms the buy and hold benchmark in terms of annualized returns, but falls slightly short of the MVO strategy. A key metric that hedge funds and institutional investors look for in investment strategies is diversification. Strategy with low or negative correlation to traditional assets and other strategies can provide significant diversification benefits, potentially improving the overall portfolio's risk-adjusted returns. As we can see in our correlation matrix, we observe high Pearson correlation across the board, especially between our reinforcement learning strategies and the benchmarks for mean variance optimization strategies and buy and hold. Achieving uncorrelated returns is challenging in a long-only framework where all strategies are exposed to general market movements, and so we will attempt to develop a more sophisticated reinforcement learning environment that allows for long-short neutral portfolios and hopefully achieves better diversification. In this long-short framework, we define an action space of 100 dimensions, corresponding to our universe of 100 stocks. We ensure that the portfolio maintains a market-neutral position by enforcing the sum of all weights equal to 0, while the absolute sum of weights equals to 1, allowing for equally weighted long and short positions. Here we see that we also achieve a higher Sharpe ratio than before, illustrated by the smoother and more consistent red and blue lines. This is at the cost of lower annualized returns compared to the benchmarks, but we can see that the A to C strategies take on much less risk as they are less exposed to the large swings of the general market. We can also see that the long-short portfolio environment allows us to drastically reduce correlation to the benchmark strategies and could now be a valuable addition to a diversified investment portfolio. Moving on, we further augment the reinforcement learning frameworks by optimizing for Sharpe ratio instead of raw returns. This change aims to balance return maximization with risk minimization, potentially leading to more stable and efficient portfolios. We see that this change allows the A to C strategies to now significantly outperform our benchmarks in terms of Sharpe ratio, and the predicted signals achieves an impressive 1.19 Sharpe ratio result. Thank you for listening to this presentation on Fuzzified stock market forecasting with transformer networks and adaptive portfolio management using reinforcement learning. Here are the references.